Hello and welcome back to the Youth Ledger. I'm your host, Shivan Diwakar, and this week the world has been anything but calm. Japan's political landscape just shifted in a way that could rattle US trade talks. Washington is preparing a tariff storm that might rewrite global commerce, and Xi Jinping is rolling out the red carpet for Europe in Beijing. Markets hit record highs, but risk warnings are flashing red, and major powers are doubling down on energy, tech, and defense strategies that could redefine the next decade. So let's dive right in. First up, in Japan, Prime Minister Shigeru Ishiba and the Liberal Democratic Party have been rocked by a historic loss of control over the upper house. Despite the setback, Ishiba has affirmed his intent to remain in power and expedite trade negotiations with the United States. This comes amid higher domestic living costs, rising rice prices, immigration debates, and fears of US tariffs on Japanese exports. Notably, while Tokyo markets were closed for a holiday, the yen did strengthen slightly, signaling investor recalibration. Investors seem to have expected an even worse outcome for Mr. Ishiba, with some even expecting his resignation. Comparatively, the outcome we got was quite mild, which I think is what helped markets to stay strong. China has confirmed a high-stakes summit in Beijing this week, marking the 50th anniversary of diplomatic ties with the European Union. European Commission President Ursula von der Leyen and Council President Antonio Costa will meet President Xi Jinping, with Premier Li Qiang co-chairing the 25th China-EU summit. The timing is critical. Both sides hope to manage trade disputes over EVs, rare earths, pork, medical devices, and more, while navigating ongoing tensions stemming from sanctions and counter-sanctions that have been placed. Although the US will not be there in person, the Trump administration's presence will definitely be felt when it comes to discussing policies and negotiations. Only time will tell how exactly all this will manifest. Speaking of the Trump administration, back in Washington, they are gearing up to impose a 30% tariff on a broad range of EU imports due August 1st. The EU has prepared a €72 billion retaliatory package, and Commerce Secretary Lutnick, meanwhile, expresses optimism, hoping the EU will opt for deals over tariffs. HSBC strategists have signaled this could be one of the 5 major risks threatening the US market rally. Others include rising treasury yields, shifting sentiment, labor weakness, an over-reliance on AI, and possible political meddling with the Fed. Speaking of the Fed, it is reported that President Trump drafted a letter to fire Fed Chair Jerome Powell and discussed it with congressional Republicans. He denies this, but nonetheless, this could send the markets into chaos. Jamie Dimon, the CEO of JP Morgan Chase, even advised him against it, citing potential adverse consequences. Last week, markets were quite buoyant. The S&P 500 and Nasdaq both hit record highs, while the Dow gained modestly. However, futures were relatively flat as the trade deadline loomed. In the UK, the FTSE 100 remained flat despite sterling strength, and mining stocks rose enough to offset weaknesses in defense and consumer sectors. In geopolitical conflict, President Vladimir Putin maintains a hardline approach in Ukraine, ignoring even US peace overtures tied to NATO exclusion and territorial concessions. The result? Russia's global influence is waning, making the country increasingly economically dependent on China and India. Nearly 40% of its budget is now devoted to defense, and the domestic economy is flirting with recession. Early in the war, it seemed to many, including myself, that Putin was trying to play the long game, hoping that Ukraine's economy and morale would give out, allowing for a Russian victory. However, it now seems that Russia could be the one with economic troubles, as Ukraine is being increasingly supported by the United States and Europe. A report from SAFE urges the US to reclaim its industrial edge, recommending federal support for EVs, solar, battery tech, small modular reactors, and mineral sourcing. Meanwhile, in Tibet, China has begun constructing its next mega hydropower dam, reportedly costing around $170 billion. In England and Wales, June saw a slight decline in company insolvencies, 2,043 filings, down 8% from May and 16% year-on-year. In the US, President Donald Trump continued his campaign against Federal Reserve Chair Jerome Powell, as mentioned before with the letter, advocating for aggressive rate cuts down to 1%, with murmurs that Fed Governor Waller could be amenable to stepping in. Other notables from this previous week include global business travel scaling back, companies are drastically reducing or cancelling business trips to the US due to safety concerns, budget tightening, and shifting trade priorities. Also, Nvidia's H20 AI chips have been approved for China once again. The administration has approved exports of Nvidia's H20 AI chips, potentially easing some bilateral tech tensions. To sum up, the world remains at a delicate geopolitical economic inflection point. New trade deadlines, summit diplomacy, global market highs, and hardline positions across many fronts illustrate a world in constant flux. For now, thank you for tuning into this deep dive of the week's biggest developments. If you found this episode insightful, subscribe and follow. Make sure to check out the TikTok and YouTube pages if you haven't yet. And as always, please share your thoughts below. Signing out, this is Shivan Diwakar. See you next time on the Youth Ledger.